How much money do you think the average person actually has when they finally decide to stop working? Is it the $1 million we often hear about in the news? Or is it much less than that? The truth is that most people are walking into their golden years with a deep sense of fear. They are afraid that a single market crash could wipe out decades of hard work. They are afraid of becoming a burden to their children. But what if I told you that the biggest risk to your retirement is not the market itself? The biggest risk is the strategy you choose to follow right now. Many investors spend their days staring at charts and waiting for the perfect moment to buy. They want to buy the dip. They want to wait for that 10% drop to get a better deal. It sounds logical and it sounds smart. But for someone in their 50s or 60s, this logic can become a dangerous trap. You do not have the luxury of time that a 20-year-old has. You cannot afford to sit on the sidelines while inflation eats away at your hard-earned savings. In this discussion, we are going to look at the two most common ways to build wealth. We will compare the steady path of dollar cost averaging against the thrill of buying the dip. We will look at real data from major financial institutions like Charles Schwab. And most importantly, we will find the path that gives you the one thing money cannot always buy. That thing is peace of mind. Let us start by looking at how most people actually behave when the market gets volatile. When stock prices start to fall, our natural instinct is to protect what we have. We tell ourselves that we will wait for the bottom. We say we will jump back in when things look safe again. But the problem is that the market never sends a clear signal when it reaches the bottom. By the time you feel safe, the best days of the recovery have usually already passed. Think about the stress of trying to time the market every single week. It takes you away from your family and your hobbies. It turns your retirement planning into a second full-time job that you never asked for. Now, let us look at the alternative, which is dollar cost averaging. This strategy is simple but incredibly powerful. You invest a fixed amount of money at regular intervals regardless of the price. Whether the market is up or down or moving sideways, you stay the course. When prices are high, your money buys fewer shares. When prices are low, your money buys more shares. Over time, your purchase price averages out. This removes the need for guesswork and it removes the emotion from the process. It turns investing into a machine that works for you while you sleep. To prove why this works, let us look at a famous study involving 5 different types of investors. This study tracked their performance over 20 years of market ups and downs. The first investor was named Peter Perfect. Peter had a superpower because he always invested his money at the exact lowest point of the year. He timed every single dip perfectly for 2 decades. As you can imagine, Peter ended up with the most money. But here is the catch. Nobody in the real world can be Peter Perfect. Even professional hedge fund managers fail to time the market consistently. The second investor was named Ashley Action. Ashley did not care about the news or the charts. She simply invested her full amount on the very first day of every year. She did not wait for a dip, and she did not try to be smart. The third investor was Matthew Monthly. Matthew used the dollar cost averaging strategy. He broke his annual investment into 12 equal monthly payments. The fourth investor was Rosie Rotten. Rosie had the worst luck imaginable. She always invested her money at the very highest point of the market each year. And the final person was Larry Linger. Larry was convinced the market was too expensive. He kept his money in cash and waited for the perfect dip that never seemed to come. After 20 years, the results were shocking to most people. Peter Perfect obviously came in first place, but Ashley Action, the woman who just invested immediately, came in a very close second. Matthew Monthly and his dollar cost averaging strategy were right behind her. Even Rosie Rotten, who had the worst timing in history, still built a massive fortune. But what about Larry Linger, the man who stayed in cash? Larry ended up with less than half of what the others achieved. The lesson here is very clear for anyone approaching retirement. The cost of waiting for a dip is almost always higher than the benefit of buying one. When you sit in cash, you are missing out on dividends and compound growth. You are betting that you are smarter than the entire global economy. For a person in their 60s, every month spent on the sidelines is a month of lost momentum. Dollar cost averaging works because it aligns with how our brains are wired. It is much easier to stay disciplined when the process is automated. You do not have to wake up and decide if today is a good day to buy. The decision has already been made by your plan. This is especially important during a market crash. When the news is full of fear, most people stop investing, or they sell in a panic. But if you are using dollar cost averaging, you keep buying. You end up buying more shares at a discount when everyone else is running away. This is how true wealth is built during the most difficult times. Now let us talk about how to apply this to your life right now. If you have a large amount of cash sitting in a bank account, you might feel paralyzed. You worry that if you invest it all today, the market will crash tomorrow. This is a valid fear, and it is very common. In this case, you can use a modified dollar cost averaging approach. Take that large sum and divide it into 6 or 12 equal parts. Invest one part every month for the next year. This allows you to get into the market gradually. If the market goes up, you are happy because your first investments are growing. If the market goes down, you are happy because your next investments are buying more. It is a win-win situation for your mental health. As we move toward the year 2026, the world feels more uncertain than ever. We hear about inflation and global conflicts and political shifts. It is easy to feel like now is a bad time to start. But history shows us that there is never a perfect time to start. The best time was 20 years ago. The second best time is today. Your retirement should be a time of freedom and joy. It should not be spent worrying about the daily movements of the stock market. By choosing a disciplined strategy like dollar cost averaging, you are taking control. You are deciding that your future is more important than your fears. You are building a legacy that can support you and your loved ones for decades. Remember that wealth is not just about the number in your bank account. It is about the security of knowing you have enough. It is about knowing that your plan is solid regardless of what the news says. Start small if you have to, but start today. Automate your investments so you do not have to think about them. Focus on the things that truly matter in your life. Spend time with your grandchildren or travel to the places you have always wanted to see. Let the market do the heavy lifting for you. You have worked hard for your money. Now it is time to let your money work hard for you. Consistency is the secret weapon of the successful investor. It is not about being lucky or being a genius. It is about being steady and being patient. The road to a secure retirement is paved with small and regular actions. You have the power to change your financial future starting right now. Trust the process and trust the data. Your future self will thank you for the decisions you make today. Thank you for spending this time with me. I hope this gives you the clarity and the confidence you need. Take care of your health and take care of your wealth. I will see you in the next one.